So our next guest really doesn't need a standard introduction. The highlights, that everybody knows is the founder, CEO, co-founder, CEO of PayPal, co-founder of Palantir, founder and driving force behind Founders Fund, author of 0 to 1, which I'm sure you've all read. Probably more interesting to me is I met Peter 29 years ago, and I certainly have learned more from him than anybody else that I've met. And I probably still cite something Peter taught me every single day. So Peter, welcome. I'll give you one more anecdote. Peter, also to show the difference between the two of us, Peter was smart enough to leave the practice of law in 7 months and 3 days, I believe, and it took me 3 years and 3 days to figure out the error of my ways. Thanks.
Well, Keith, thanks a lot. I think I wanted to try to make it as interactive as possible. So, and there's so many different kinds of things to talk about. One of the things I thought would be interesting to reflect on a little bit are some of the things I've learned about venture capital in the course of the last decade. And when we started Founders Fund, one of the ideas we had around 2007, 2008, sort of a few years into it, was that we should try to brand it as the science fiction fund, where we're going to invest in the most futuristic, far-out, science fiction-like projects. We felt we could never tell people this because it would scare off all our LPs if you had that as the brand, but that this would be sort of the internal thing that we would go about trying to do. And there are sort of a number of things that, and part of the reason that animated us in doing this was that we sort of thought that there was not quite enough technological progress. It needed to be happening faster. There was a lot happening in IT, but a lot of other areas it seemed to be challenging. I was personally very interested in the biotech area. Could we do more on life extension, longevity, curing various diseases, and so we set out, a concerted effort to start investing in areas outside of just IT. And certainly some of the things have worked. Some have worked spectacularly well, and at the same time, it's been extraordinarily challenging. And one of the sort of, and I have sort of a lot of thoughts on why that is. But one of the ideas that I've sort of come back to over and over again, that's probably the single idée fixe that I have on business and investing, is that to a first approximation, you can always think about, the science, the technology, there are the people, and there's the business strategy. And people in Silicon Valley tend to talk about science, technology, and people. They don't talk that much about business strategy. And with respect to business strategy, you could say that to a first approximation, there are two kinds of businesses. There are businesses that compete, and there are businesses that don't. The businesses that compete find it very hard to make money. The ones that don't are monopolies and make a lot of money. The people who have monopolies don't talk about it, and because of this is very understated. If you want to compete like crazy, you should open a restaurant in San Francisco. It's a ferocious competition. It's nature bared red in tooth and claw, but you will never make any money. And then conversely, if you have a fantastic monopoly, and the example I always give is Google, you would never want to tell anybody because you'd want to really be careful to avoid the fate that befell Microsoft in the late 90s. And so there is sort of this this very big kind of a question. And then the technology question one has to ask is what kinds of businesses, what kinds of technology investments, since that's what we're doing, are likely to become monopolies and which ones are not. And there's certainly a science version that can be quite good, where you have an incredible breakthrough that for a variety of reasons people can't replicate, and then you can get patents around it, or it can be incredibly valuable. But the kinds of questions you have to ask are not just, is it valuable in the short run? Do you get something that's better than anybody else in the short run? But it's really a long-run question. Are you going to have a sustained advantage? When I ran PayPal in March 2001, 27 months into the business, we did sort of a discounted cash flow analysis on PayPal, which is something you almost never do in these tech companies. But because you have sort of very high growth rates, very high discount rates, and depending on how you do the math, you get very different kind of valuations. But But when you do a sort of a discounted cash flow analysis, under sort of a lot of different assumptions, the conclusion you reach is that almost all the value is in the terminal value. And so as of 2001, we concluded that 75% of PayPal's value came from cash flows in years 2011 and beyond. And this is a very counterintuitive thing, because when you look at tech companies in Silicon Valley as an investor or as a founder, you're always tracking things week to week, month to month, quarter to quarter. How much has it grown in the last year? The things you can measure are the immediate things, whereas the variable that dominates almost everything is the durability. And almost every tech company that we're invested in, I would say, 3/4 of the value comes from cash flows they'll be making in years 2026 and beyond. And so the first kind of question we have to ask is, are they still going to be around? How successful will they be at that point? And what are the structures of the market that will decide that? And so coming back to this question of how much can one invest in IT versus how much should one do the science fiction kinds of things, the perspective I've come to is that the science fiction things are very interesting because so few people are doing them. I know Khosla does quite a bit in this. We've done quite a bit, and there are really very few. So there is something about that that's contrarian, fundamental. It's not being done enough of. And then one of the challenges that I've encountered as we've built these businesses is thinking through the structure of the long-term cash flows and how they work. And one of the reasons that we've over the last decade, still always veered back to IT. So we're, probably, we do 30% science fiction, 70% IT at this point, is that the IT businesses, even if they don't transform our world as much as we'd like, are often fantastic businesses. Because in IT, marginal cost is zero. And then so at scale, it's very profitable. You often can take over a market very quickly, and then you often have a certain type of stickiness. And when you add those three characters together, small initial markets that can quickly be taken over, number one. Number two, relative stickiness of the product. And number three, a marginal cost of zero. Those three, when you combine them, lead to natural monopolies for successful businesses. And I think this is sort of the deep, secret reason why Silicon Valley, over the last few decades, has shifted so much towards this world of bits, and why there's so many important things from the point of view of society that we should be doing in the world of atoms, but that have been surprisingly challenging. And this is always the tension that I find between as a VC who's trying to get really good returns for our investors, and as a citizen of this country where I'm also trying to build companies that will really transform our society and transform the future. And it's trying to strike that balance that's always been a challenge. There certainly are contexts where you can get this to work and get it to work quite well in cases outside of IT. But I found this to be a very useful set of questions to try to be extremely rigorous around why is it a monopoly, why is it going to be one in the long run, and the fact that these are questions that are almost too politically incorrect to ask, I think, is one of the reasons why they're so constructive. So those are some general thoughts, and then maybe I'll just go with some questions from here. Thanks.
So one of the things that you've been incredible at over your career is identifying extraordinarily talented people earlier in their career. What do you look for?
Well, it's always, I think it's always a context question. So I don't think that there's such a thing as an extraordinary person completely independent of a context. And one of the things we called our fund Founders Fund, because we thought that we were going to invest in founders and find the really great founders to back. And certainly when you're starting a company, you have an idea about the technology and the business strategy, but initially, for early stage, it's really all about the people, and you need to get really good people. And one of the things an exercise we tried to do 3 to 4 years ago was write a long manifesto on what the attributes of good founders were. and I had, I was working with one of my friends, and we sort of spent, months trying to brainstorm how we would write this manifesto on what the attributes of great founders were, and there was nothing, we couldn't actually write it. It always sounded way too cliched. So you could say they're like really ambitious people, they're like slightly crazy people, they're really smart people, they're really, so you can come up with all these traits, but if you came up with them, it sounded way too cliched, and it would be like you're not telling people anything at all. And so the insight that I've come to think is that you can't abstract a founder from the company, from the context. And so even though, let's say, Elon Musk at SpaceX or Brian Chesky at Airbnb, or Brian Slingerland, who drove StemCentrx, which is our biotech company that we had a successful exit on recently, are very good. You wouldn't want to have them shift. So you wouldn't want to have Brian Chesky. You want to say, okay, we're just playing musical chairs here, and we're going to have Brian Chesky, who's running Airbnb, run SpaceX for a year, and then we're going to have the PhD biochemist run Airbnb, and on and on. And so I think, and then of course what's true of founders is also true within these companies. It's a question of how well do great people work within the team, how are they unique, and things like that. And I have this theory on management where you want to give people very well-defined roles, and in a startup, the roles are always super fluid, and so they tend to shift a lot. And if you give people roles that are too overlapping, I think this is just a formula for catastrophic internal conflict. So if you're a sociopathic boss who wants to, for just fun, get people working for you to fight each other over nothing at all, the formula for doing this is to tell two people to do the exact same thing. And they might have been the best friends before. It's going to go really wrong. And in a big standard conventional corporation, people are sort of siloed into sort of fairly nondescript roles. Not very much happens, and there's sort of just this chronic level in which everybody kind of dislikes everybody, but it's never that acute. Whereas in a startup, it tends to be much more volatile, and there are sort of these very acute things that can go wrong because the roles are more fluid, and the risk is always that they start overlapping into this catastrophic way. And it's so even if you're doing a really good job of trying to manage it, you may still have a lot of crazy conflicts. And so I think if you have really good people, question is how do you get them to sort of work with each other and avoid conflict? At PayPal, we had a group of really talented people. We certainly had our share of conflict, and there was a lot. It was generative up to a certain point, and then you had to also really curtail it. The head of the product team, David Sachs, liked to have the expression that the product was a single seamless whole, which on one level was true, but on another level was a reason that the product team was in conflict with everybody else, because if it's a single seamless whole, then it dominates legal, and it dominates fraud, and it dominates engineering, and it dominates design, and it dominates business development. And so while that was on one level true, on another level it was something I always had to try to moderate and push back on so you could get people to do all their respective things really well.
So two management sort of techniques you taught me. One is the concept of focus and having people really focus on one thing and one thing exclusively. Can you talk a little bit about that?
Well, that would be a corollary to this. So on one level, it's not a rational thing at all. So you'd say people can do a number of different things, and so you might as well do, you can do 5 things in your responsibility, and one thing should only take 70% of your time, and you should then spend some time on the other things. But one of the reasons I like the focus idea is that I think absent that, you end up with these conflict problems. So if you tell people there are 5 things for you to do and there are 5 things for this person to do, then it becomes much more likely that you start with these converging roles that overlap. And of course, it's also likely that people will do the 4 things on the list that are relatively easy and relatively unimportant. So as a manager, focus has 2 benefits. One is to not let people avoid doing the hard and valuable things, rather than a long list of not so valuable but relatively easy things. So 4 out of 5 may be worse than 1 out of 1. as a score. And then, but then the second reason is to avoid this conflictual dynamic where it's much easier if you give someone one really important thing to do, see that that doesn't overlap, versus a list of 10 things, and you'll be surprised how quickly they overlap.
So the other technique that was sort of unusual back at PayPal and also at Clarion was you would hire a lot of, let's say, junior people who had promise and sort of assign them to do stuff, but they didn't really have a defined role, and just see what would happen. And it would drive like the people who hadn't worked with you before crazy, because these people would show up without a job. Do you still subscribe to that view, and what are the merits of it?
Yeah, so it's so the problem is that you do end up with a lot of conflict for all the reasons we just outlined. So that is the downside. The benefit of doing that is that if you have talented people, they can scale in quite a few ways. And I think the alternative to that is always that you end up hiring people horizontally. And so I think that in practice, if you're in a fast-growing startup, one choice is to hire very talented junior people that you might not have precise roles for, to try to get them up to speed and then get them working on important things. And the other one is to scale by hiring people horizontally with expertise in some sort of management process. You can probably go wrong by doing too much of one or the other, but certainly in the late 90s context, during the tech bubble, my bias was that it was too hard to hire good, experienced people horizontally, because if they were actually good, they would command such a premium that you wouldn't have much of a company left after you hired 2 or 3 of them. You had to give them pretty much all the equity. Or you would get people who looked good on paper but were really quite bad. In a less bubble-like environment, I think you could probably do a little bit more on the horizontal side. So it depends on the much larger context. But I don't think we're in anything quite like as extreme as the 99-2000 bubble. But certainly today, I would again tilt things towards the organic, hire people people you're friends with, even if you don't have specific jobs for them, you scale them rather than trying to build things horizontally, because I think the pricing would be too high on the second one.
So looking at your startup class at Stanford, one of the things that struck me as most important was this concept of secrets, and that all good companies, all new founders that have high potential, have some secrets that basically are things they believe about the world that nobody else believes, and they turn out to be true. Do you have any secrets that you'd share with founders about Silicon Valley today?
Well, I'm always if I shared them with you, you wouldn't really believe me, or something like that. So I do think, as an investor, you're always looking for some kind of edge. So the 2 questions as an investor is always, is it fundamentally good, and then why isn't it already priced in? And so I always most of the rest of the people on our team focus on the fundamental question. I tend to focus on the contrarian question. So it's always, what do we understand about this that nobody understands? So what edge do we have? And if we don't have a good answer to that question, I think it's sort of like if you're playing poker and you're supposed to first figure out who the dumb person at the table is. And if you can't figure out who the dumb person is, it's you. And if you can't answer the question, what's your edge? What do you understand that nobody else does? Then maybe it's just a really bad idea. So you always try to get it. It tends to always be very specific to the context. One of the versions of this question I always get asked are, what are trends in technology? What do I see happening? And I think that's slightly too abstract a one to answer. At least I'm uncomfortable. I don't feel that I'm a prophet and I can really foretell what's going to happen, or even if there's a trend. Like there are more people using smartphones, and there'll be more people using smartphones in 5 years than now. It doesn't necessarily translate into a company on that level. And there certainly are trends in Silicon Valley around educational software, healthcare IT software, SaaS enterprise software, big trends around big data, cloud computing. I've often said that when you hear those words, you need to think fraud and run away as fast as you can. And the reason you want to be nervous about the buzzwords is the buzzwords are like the opposite of a secret. They're things that are understood by everybody. And so if you had a startup that was a concatenation of buzzwords, so for example, we're building a mobile platform for a SaaS platform mobile SaaS platform to bring big data to the cloud. That's what we're doing. My sort of pattern would be that it's like a tell that you're bluffing, that there's nothing unique about the business, and then that the really good businesses are somehow the opposite of that. They somehow don't tap into sort of a concatenation of buzzwords. And I think in some ways, the really good companies often, what was really going on couldn't even be articulated, where somehow we didn't quite have the right words. And so if you look at, or maybe they were articulated, but they were articulated in terms of categories that were actually misleading. And so people would have said that Google was another search engine or Facebook was another social network. Actually, Google was actually the first machine-powered search. And so that was actually, it was a different category. The category didn't really exist, and you had to identify that secret about Google to really see how it was differentiated. Or Facebook, there were a lot of social networking companies. One of our friends from PayPal, Reid Hoffman, started pre-PayPal, in 1997, had started a company called SocialNet. So they had social networking in the name of the company 7 years before Facebook, and it was about people networking as, it was all going to be in cyberspace, and we had these avatars, and some people would be virtual cats, and other people would be virtual dogs, and they'd be networking as virtual cats and dogs. And it turned out that was actually not what really mattered. And perhaps networking doesn't matter at all, and perhaps people don't actually even want to network. And what actually mattered is real identity. And this is what Facebook cracked. It was the first it was not a social networking company at all. It was a company that cracked real identity. That's what makes it powerful. That's what makes it somewhat controversial. And we're still miscategorizing it 12 years after the fact. And so I think one of the challenges, it's always very hard to sort of, to sort of extricate this, because you're always tempted to come up with these buzzword summaries. It's the fifth Uber for cats, or it's the 100th Airbnb for dogs. And that's very easy to understand as a business because it's tapping into these conventionally understood categories. But I probably would not recommend investing in the Airbnb for dogs.
So on the science fiction companies, you also have a philosophy that's somewhat distinct about the team. You like to have a senior, the leading business person already on the team when you invest. Talk about why.
Well, it's you always I want to sort of qualify. You always want to be careful about being too dogmatic. So you always come up with lots of rules, and then if you apply all the rules, you'd never invest in any company. So you have to always be somewhat dogmatic, so you can have some shortcuts, but not way too dogmatic. But yes, I think one of the challenges in some of the science fiction companies is that they've tended to be somewhat more capital intensive. And so the business side of it, so even just the financial side of raising the capital or cutting complex business development deals, ends up being actually more important than something like consumer internet, where maybe you can thinly monetize through advertising, which just works at scale. And so you could start a consumer internet company with 2 engineers who don't know that much about business, and then the microeconomics are such that they can learn business over time. Whereas if you had, say, a biotech company, and it's much more capital intensive, and the scientists on average are less good at business than engineers. So I say engineers on average are not that good at business. The scientists on average are catastrophic. And then if you put them in something where it's super capital intensive, that can be somewhat of a challenge. So I think if you can get that combination right, it's quite valuable. I've often thought that we have never quite figured out how to do this, but I've thought if you could actually engineer this systematically, this would be quite valuable. If you could systematically find a way to pair really good scientists with really good business people, this would be incredibly powerful, because there's a certain degree to which it's not quite natural. I'm always biased. These things are supposed to happen organically, and we're just passive investors, and we shouldn't be. We're not like the unification church that's like organizing all these marriages between scientists and business people. But the problem is that the average scientist, their image of a good business person is that it's someone who looks like a used car dealer. And the average business person, their image of a scientist is it's like maybe it's an actor from the Big Bang TV show or something like that. And so it's quite hard to actually get it right.
So let me push a little bit on your theory of competition and anti-competition. So two companies that are significant investments in Founders Fund are Lyft and Stripe. Both at least superficially are in very competitive markets.
Let's see. I don't want to say anything bad about any of the companies we're invested in, so I have to be careful about this. So I would say that I would say that with respect to Lyft, at the time we made the investment, we analyzed it as a bifurcated market. So we thought that there was one market where it would be driven by quality, and one market that would be driven by price. And we thought there was sort of room for two businesses. It's still possible that's the case. There still are sort of a lot of very strange dynamics around the market. It's certainly you can't always predict the structure of these markets correctly, and so it certainly turned out to be more competitive than we initially thought, even though it also turned out to be a lot bigger. So sometimes you have a super big market, even if it's competitive, it can still be quite good. With respect to Stripe, it's true that I'd say payments generally is sort of both super big and super competitive. The angle that Stripe, I would say, had early on is you can always have a monopoly on the level of the technology or the business. You can also have a monopoly on the distribution level, and Stripe had sort of a completely different distribution channel of going to sort of directly to the designers and the engineers to install the product, and it was very different from the way payments companies were typically being rolled out, where it was to some vice president of sales or something, or marketing or something like that at a website. And so because they mastered this alternate distribution channel, I think that gave them a critical comparative advantage, at least at the time they were getting started. And I think at this point it's more just a scaling question.
Great. Well, we're out of time. Thank you very much.
Awesome. Thanks a lot.
Thanks, Peter. We'll take a minute to switch over, but before Peter leaves, Peter, I want to just bring one story up, one of my favorite stories. I was a telecom investor. We were at Kleiner Perkins. We'd made $7 billion in profit on Juniper, one investment, $3 billion on Cerent. And so I was like the authority on telecom investing. And I was asked to speak at a conference, which was very buzzword-oriented, given your buzzword story. So I took 10 companies at the conference, took one sentence each, concatenated it, and gave a 45-minute talk about this. My punchline being, when it gets so buzzword compliant that people fall in love, I actually called the company Idle, which is Pig Latin for light. And it was amazing how many people got really excited about this idea, which was completely a concatenation. And my point was, when you concatenate, it means everything you say is substanceless and contextless. Thanks, Peter.